So we'd like to welcome everyone to today's webinar hosted by the Social Impact Measurement Topical Interest Group of the American Evaluation Association. I'm Heather Esper, a co-program chair of the SIMTAG for short. And for those of you that are not familiar, the American Evaluation Association is an association of evaluators devoted to the application and exploration of evaluation as a profession. We have over 6,000 members representing 50 states, as well as more than 80 foreign countries. And if you want to learn more about the American Evaluation Association, I just popped something in the chat that you can look at. Oh, hold on a second. All right, so the Social Impact Measurement Thematic Interest Group is called the SIMTAG for short. We're a group of AEA members who are interested in the topic of social impact measurement and management and exploring the interplay between the social and financial return of investments. We come from many different backgrounds, from evaluators to evaluation commissioners, investors to investees. And membership in our TIG means that you want to learn more about evaluating the social impact of organizations that are aiming to produce both the social and financial return. So we're always welcoming new members. You can learn more about our TIG at a link I'll share later in the chat. And I'll also share the link over here for our other videos that we've done in the past for our webinars. Each fall, we elect a leadership team, and we're biased, but it's a fun way to help build this community and to network with others. So if you're interested in joining the SIMTAG leadership team, I'll pop also in the chat after I'm done talking, Courtney, our chair's email address, and you can email her to learn more about that and express your interest. Today, you're going to see a number of people from our leadership team on the call, and we're happy to answer any questions you might have about membership or joining our leadership team. And each webinar in our series, this 2022 webinar series, touches on the AEA conference theme, which is reshaping evaluation together through exploring shifts that are disrupting evaluation practice. And we encourage everyone to join us for our annual conference in New Orleans, November 7th to 12th, as well as a related town hall that's going to happen next month, focus on how we can transform capital with evaluative thinking. So without further ado, I'm going to turn it over to my co-program chair, Sasha, to introduce our panel today.
Thanks very much, Heather. Hi, everyone. It's really good to see some kind of repeat customers of our webinars and some new faces. So welcome all. I'm Sasha Zuva, and I'm on the board of the SIMTAG along with Heather. And in my day job, I'm a Director of Strategic Learning and Impact at the Rockefeller Foundation. Our exciting webinar today will briefly introduce you to the basics of impact investing and talk about how impact is increasingly incorporated into investment decision-making. Specifically, we'll hear about how community development financial institutions, so CDFIs, balance financial risk and return, and how they see the potential of their investments and investment process, importantly, to advance racial equity. It's very topical, very important, and there will be sessions on this at the AEA conference as well that Heather mentioned. So we hope you guys join. Before we dive in, I did want to repeat that this is a series of webinars. All of the webinars are recorded, and all of them are on the AEA SimTig website or on the YouTube channel that you can just Google. It's AEA SimTig Webinars YouTube channel. And I think you have a link in the chat already. And all of our webinars this year have been linked to the upcoming AEA conference, which is Reshaping Evaluation Together, and really focuses on the intersection of three themes: equity and social justice, new funders and social finance, and digital data and technology. And as you'll see, this webinar actually slots very nicely into this intersection. So without further ado, I'll introduce our speakers. So we're lucky to have with us Mike McCreless, who is the Executive Director of Impact Frontiers. Impact Frontiers is a community of leading impact investors working to set and achieve integrated impact and financial goals. Before this, Mike was involved with the Impact Management Project, which I'm sure you guys are familiar with, and if not, we'll mention it today. We are also very lucky to have Eliisa Frazier, who is the Director of Racial Equity and Impact Lending at the Low Income Investment Fund, where she leads the development of financial products and impact assessment tools to advance racial equity in community development finance. And we have Jessica Standiford, who is the Vice President of Development and Impact Investing at Low Income Investment Fund as well, with a background that spans nonprofit development, impact investing, consulting, and experience. So Mike, take it away.
Great. Thank you so much, Sasha and Heather, and thank you to everybody for joining. It's so great to be here with you. And I will just briefly share a few words and then hand it over to the real stars of the show, who are Eliisa and Jessica. But just keeping in mind that some of the group today may not be as familiar with impact investing, I'll share a little bit about what it is, how we think about impact in the context of impact investing, and then hand it over to Eliisa. For context, my background, I came at this more from the nonprofit side. I had some private sector background and then some evaluation background, and then spent 9 years of head of impact at an organization called Root Capital, which is a nonprofit social investment fund that provided loans to smallholder farming communities in Africa and Latin America. And I was the first person that they had hired to be the full-time impact person, across monitoring, evaluation, strategy, and all of it. And I frankly had less evaluation background than many of you on the call. But even with the evaluation background that I had, it became clear that, gosh, these loans are impactful, but some of them are more impactful than others, honestly. And so being head of impact, I said, hey, Root Capital, could we please go do more of those highest impact loans? They said, whoa, Mike, we got to think about risk. We got to think about return. You can't just go charging off in the direction of, highest impact without thinking about the consequences. And ended up going through a real process to build an integrated model for how did we think about optimizing impact relative to financial risk and return simultaneously. And that's what Impact Frontiers now does with great partners with the Low Income Investment Fund and many others. I'll briefly share my screen and switch. Let's see. So just to start at the beginning, what are impact investments? Impact investments, according to the definition commonly accepted from the Global Impact Investing Network, are investments made with the intention to generate positive, measurable, social and environmental impact alongside a financial return. It's quite broad. They could be, profit seeking, or it could be nonprofit. It could be return maximizing or not return maximizing. There are foundations that intentionally make investments that do accept a less than market rate level of financial return in order to achieve impact that doesn't occur otherwise, or that wouldn't occur otherwise. And there are also many impact investors that seek to create what's called market rate, risk-adjusted financial return in addition to impact. The institutional setup is maybe a little bit different than what evaluators are used to. And so I thought we would just walk through the overall landscape quickly here. On the slide are the different roles in the ecosystem. So these are, different people might wear different hats at different times. So these are not really people, these are just sort of roles. Starting from the left with people and planet, might, in other contexts be called stakeholders or beneficiaries, although that term is not used as much these days. And then moving up to businesses, asset managers, and asset owners. So the investors are the two right side boxes, the asset managers and the asset owners. A little bit more depth, starting with the businesses, we have privately owned businesses such as hair salons, or even large companies that are not listed on the stock market. And we also have publicly listed, meaning that they are listed on the stock market. So the publicly listed businesses, you can go to a brokerage and buy a share of those companies' stocks, or the debt that they issue. Privately owned, you can't. Those businesses in turn are the focal point for the impact that occurs on people and planet. So those businesses could be impacting the consumers of their products and services, but also their suppliers, their employees, even the communities they operate in, as well as climate and the environment. So that the business and people and planet is the nexus where the impact really occurs for people and planet. The asset managers are investors. It's simplest to think of them as any investor who invests directly in a business. And then the asset owners, for this purpose, are upstream investors who invest in asset managers. So the asset managers might be like a mutual fund that invests in the shares of publicly listed companies, or it might be a private equity or venture capital fund that buys shares of private startups. And then importantly, there are community development financial institutions here in the US, of which LIIF is a leading one. And I'll let Eliisa and Jessica provide an introduction to CDFIs and their work. And then asset owners or organizations like pensions, endowments, high net worth individuals, or even retail investors who don't usually invest directly into businesses, but we hand our money over to asset managers to handle our investments for us. But we're the sort of end owner of the assets. In the typical working of capitalism, investment capital flows to the left on this slide, and goods and services flow to the left, and profits flow to the right. So, we hand our money over to a pension, they invest in an asset manager, the asset manager will invest in a bunch of businesses, the businesses will grow, provide products and services to customers who will pay for that. Those products and services and the capital flow back up the chain. And in the traditional working of capitalism, the system is bounded by regulation and law, but there's very little information about the impacts of the companies on people and planet other than that which is required to observe local law. In impact investing, we're challenged to allocate the capital to the companies that are both doing well as businesses as well as doing good for people and planet. And so it introduces this new informational need, which is all of a sudden the businesses and then the upstream asset managers and asset owners need to know what impacts your company is having on people and planet, on their consumers, suppliers, employees, and on the climate and on the environment. And a vast infrastructure is in the process of being built to generate and to facilitate the flow of this information upstream so it can be incorporated into decision making. The term of art for this practice is impact measurement and management, which in the GINS definition includes identifying and considering the positive and negative effects one's business actions have on people and planet, and then figuring out ways to mitigate the negative and maximize the positive in alignment with one's goals. Impact measurement and management is iterative by nature. And while impact measurement and management is in some ways challenging, it is a discipline in and of itself, so is investment, and both disciplines have established, codified processes by which they operate. So investors have developed a robust set of frameworks to guide investment decision-making to optimize across financial risk and return. And investors who learn that discipline almost never hear about impact. And on the other side, social scientists and policymakers and nonprofits have developed robust approaches to impact management. But when you set out to learn those approaches, you typically don't learn anything about investment management. And so one of the real challenges in impact investing is in putting these two things together and finding that there's actually no commonly accepted way to consider the financial and the impact dimensions of performance together in an integrated way. For folks like me and perhaps some of you, it's almost like feeling like we have two sides of our brain, the financial side and the impact side, but we can only think with one side at a time. And so the skill that impact management professionals within the context of investing are building is to build those connections between the two sides of the brain, so that we can incorporate impact dimensions alongside the other dimensions of financial impact to make investment decisions and optimize portfolios in light of all of those factors. Some of the early challenges for folks that are doing this is that even though we start out with the best of intentions, it can sometimes degenerate into just a checking the box exercise. you know, you certainly start out with, it's a very natural place to start out, to think, okay, well, you know, I think that one, you know, area of one sector or one geography is particularly high impact. So I'm going to restrain my investing to that sector, then invest normally. And then on the back end, oh gosh, I should report something. I'll report number of people reached or something like that. But it ends up, there's a risk that it ends up being a little bit shallow, that we don't have contextual information about what were the experience of those people prior to the investment, what was the nature of the impact that it experienced, what might have happened otherwise, and so forth. And so there typically is a learning curve from approaches to impact management that start out sort of being check the box exercises, to progressively building the muscles to incorporate to think about impact in a more multidimensional way and incorporate it into decision making more consistently throughout the investment process. And to help with this, we've seen this whole wave of hires and this whole new role of professional impact managers within lending and impact and investing institutions. Even more ESG, which is sort of in the more mainstream markets, environmental, social, and governance factors. But I think that impact is not far behind. And we have two of the leading practitioners of this new art with us, Eliisa and Jessica. So with that, I would love to hand it over to them.
Great. Thank you, Mike. It's great to be here. Thank you so much for having us, for your interest in learning about our industry and how we manage impact. I'm going to share my screen. Tell me if you see, do you see just a slide? No notes? Looks good? Great.
We see notes.
Oh, you do. Is that better? I thought I did it. Sorry, guys. Technical. Okay, let's try again. How does it look? Good? Great.
Yeah, it looks great.
Okay, thank you. All right, diving right in. So LIIF, Low Income Investment Fund. We are a national CDFI. I'm the Director of Racial Equity and Impact Lending at LIIF. So it means I sit in the lending team and I essentially enable our lenders to lead with impact when they are looking to make loans. Jessica, who will speak a bit later, is working on our nascent learning and evaluation work, where we are starting to figure out how do we take this impact that we expect on the front end when we're making a loan, and then find out later on whether that impact actually came true, which I guess you guys know, you're evaluators. So LIIF, our mission and vision is that everyone in the United States should benefit from living in a community of opportunity, equity, and well-being. We do this by mobilizing capital and partners to achieve this vision for people and communities. We're a CDFI, so we are really set up specifically to be mission-driven, to achieve impact with the types of investments, partnerships, programs that we provide. A CDFI, just a little quick background. We're mission-driven financial institutions, have been around for many years. Specifically set up to drive economic, social, and racial justice. At LIIF, we are set up as a nonprofit organization. So we borrow money from big banks, and then we lend it out to the projects that we are looking to support, to the borrowers that we're looking to support. And this is a tagline I got from our industry organization. CDFIs see people and opportunity where others see risk. So if you think about traditional banks like your Bank of America, Wells Fargo, they are set up in a regulated environment and have certain parameters around how much risk they can take. CDFIs, our parameters around risk are a little bit broader. And so we are able to do the kind of financing, make the types of loans that traditional banks are not able to do, which is why we were created in the first place, to really uplift and advance underserved low-income communities with additional investment. So started saying this, just a key thing to remember at LIIF, yes, we are a nonprofit. That doesn't mean no profit. We still have to keep our lights on. We borrow money from banks typically under their Community Reinvestment Act obligations. These are obligations to make investments in the communities where they're taking deposits. So they invest in LIIF. We take that money and we go ahead and lend it out to affordable housing projects, education projects, other community facilities projects. And then we earn a little spread on that, and that's our profit to keep the lights on, to keep our organization going. We've been in business about 37 years. You can see we've invested a lot of money over that time. What I want to really point out in this slide is that, historically, and even now still, the CDFI industry and LIIF, we have talked about impact in terms of outputs. Mike said a little bit about this, and that you can count the number of affordable housing units that you've created with a loan. You can count the number of school seats that you've created with a loan. We have used a social impact calculator in the past to estimate how the dollar amount of the benefits of creating those units or creating those school seats. And we're ready to do more. So whereas we've done outputs in the past, we're really starting to look for outcomes and connect a bit more to what's really happening to the people and communities that we're trying to impact with this investment. And we'll get into that a bit more. Okay, so we're here to talk about decision making. So LIIF has been around 37 years. We've been a mission-driven lender for 37 years. What's new, what's different, what's changed? In the last 2 years, we've really started to think about how to make better lending decisions that center impact and more specifically center racial equity. So we are saying to ourselves, all right, we have this kind of mission, this bucket, but within this mission, within affordable housing, what is the kind of project, what is the kind of borrower that has the greatest potential for driving racial equity? Because we want to put our resources there. We want to put our most maybe concessionary capital, where we're taking a hit on profitability or where we are being flexible on risk. When we're doing those things, we want to make sure it's driving the most impact. And so we've been developing 3 tools for our impact risk profitability framework. This is an impact scorecard, a risk rating model, and a profitability model, with the notion that if we have these 3 pieces of information, these 3 data points on every loan in our portfolio, we can start making better decisions about how to balance that impact, risk, and return. And when it comes down to that decision making, it's really, at the end of the day, it comes down to helping our lenders who are out there developing business identify those kinds of projects that are going to be most impactful, and structuring the loans with profit and risk in mind to drive that impact. And also to mobilize the capital. I talked about how banks lend to LIIF and we lend that money out. We want to motivate our investors who are investing in LIIF and CDFIs to give us that, lend that capital that's really going to do the most to drive racial equity. And so that's really where we're trying to go with building this model, is to mobilize more of that capital and get more of that capital out. So I talked about the 3 tools. So just to kind of get in a little bit into the weeds here, the impact scorecard that we're developing, it's still in development. We haven't finally launched it yet, but it's in beta testing with the team. We expect there to be an impact score out of about 25. So every loan you go through the impact scorecard, you see, how does this loan stack up against all these different dimensions, and then it gets an impact score. It also gets assigned a racial equity tier, which I'll talk about a little bit more on the next couple of slides. But this racial equity tier essentially reflects the potential for this loan, this project, this borrower to drive racial equity relative to other opportunities. On the risk side, we have a risk rating from 1 to 5 at originations. This is where 1 is better because it's lower risk. 5 is higher risk. And I will say we've always had risk ratings at LIIF because, as a bank, we do need to estimate the risk of repayment. That's a key piece of our business as lenders. But we have a more refined model that's getting a little bit more granular on getting that risk rating together. And then on profitability, we have a model that measures the expected profit to LIIF from this loan, we use net present value, which is a financial term for estimating how much profit that the organization is going to earn over the life of the loan. And then a modified rate of return, which is, it's a way of expressing the expected return in a percentage. I don't think it's worth getting into more detail about that. It's a big finance term, but think, these are the values that help us see how likely, how much profit we expect to earn from that loan. So these three things put together are going to help us make better decisions to drive more impact. So when we talk about impact, well, so I will say as a bank, as an investor, financial return has always been the name of the game in investing. So this notion of profitability feels pretty tangible, something that you can kind of say, well, if the loan is bigger or we have priced it at a higher interest rate, it's probably going to earn us more profit. From a risk perspective, credit risk, being a lender, being in the debt game is all about investigating and underwriting and figuring out, are we going to get paid back? How are we going to get paid back? What if we don't get paid back? How much do we stand to lose as a bank? That is the name of the game in banking and underwriting, and that's the business we've been in for a long time. Figuring out the impact score and the likely impact of this loan is much harder to identify. We have sort of, we've been, as I said, mission-driven lenders for a long time. So we have these sectors that we work in. We kind of know the actors in the overall community development space. But when we start talking about something like racial equity, which is hugely important, and is also, how do you articulate it? What exactly does it mean to drive racial equity in the context of community development finance? And so this impact scorecard is really where we've spent most of our effort on the IRP, impact, risk, and profitability framework over the last year and a half. This is a summary of the impact scorecard. The takeaway here is to see the dimensions of impact. So these are the different dimensions we're looking at when we look at a potential project to lend to. We're going to be assessing power and control, community voice and agency, systems change, population served, location quality, catalytic impact, access. Don't have to remember those all. I'm going to show some examples in a little bit to illustrate this. But this is the set of dimensions we're looking at that are scored out in those 25 points. We also are looking at LIIF's contribution. This is in the term of art is, I guess, is additionality or investor contribution. So what is special about LIIF's role in this transaction that is really driving the impact? So these are the dimensions. And then along here are the racial equity tiers. So we look at this cumulatively and we say, if an organization is increasing access to critical resources or opportunities for Black and Latino people or other communities of color, it's creating access, it's racial equity serving. If this is a project that is also driving transformative outcomes for Black or Latino people or other communities of color, then it is considered racial equity centered. If this is a project that is creating access, driving outcomes, and is delivering power and agency for Black and Latino people and other communities of color, then we consider that a racial equity standout loan. And the key here is just to see, I guess, racial equity isn't a separate thing that we're measuring. This is overlaid on top of all of the dimensions that we are looking at when we are looking at projects and borrowers. To illustrate this again, just with the tiers, so we consider a project that's racial equity serving as one that meaningfully increases and preserves access to critical resources or opportunities for people of color. To illustrate this in the affordable housing game, so LIIF, we provide an acquisition loan to a developer that's going to build 100 units of affordable housing that in the midst of a Mexican-American community. And so it's likely to increase access to affordable housing for a Latino community. That's racial equity serving. When we look at, we say, okay, great, they're building the units. What else is going on inside this property? What else is going on at this location that is going to drive positive outcomes for the people who are accessing this opportunity? We look at things in housing like services that are provided on site at housing. So is there a childcare center on the ground floor that the residents can send their kids to? Is this a building that's being built in a community where low-income residents are facing active threat of displacement? Maybe they would have to move out of the neighborhood if this building weren't built. Is this a project that is part of a broader community transformation? Maybe we are financing the building, but this is going to be next to a new school or a new health center or a new park that is being developed. Those are all things we think about when it comes to driving transformative outcomes. So we investigate those things. If it's created units and it's got these other outcomes things going on, then we consider it racial equity centered. What we're really reaching for at the top here with racial equity standout is saying beyond what's going on in that project in terms of the units, what's happening on site, we are starting to ask questions about power and agency. Who is and I'll go to the next slide for this. Power and control, who is going to be deriving economic benefit from this project? So thinking about the developer, is there leadership, is there representation of people of color in leadership and on staff? Is this a borrower organization that is committed to dismantling structural racism? Do they recognize racial equity as mission critical to their work? Do they have internal business practices informed by diversity, equity, and inclusion policies? And do they have any mechanism for ensuring community members, so residents that are going to be living in the buildings that they're building, have some kind of say in governance, have some kind of power and decision making within the organization? And when we think about agency, we also think about that decision making power and economic benefits going to the residents and community members. How are they given the opportunity to have a voice in the project design, have a voice in how the operations of the project, how the property is being managed? Is there some mechanism for sharing economic benefits with community members? These are all things we look at that. How do I go back to the last slide? In this racial equity standout section. And so if that stuff is going on, then we would consider it a racial equity standout. Time. Okay, so we talked about impact. Back again to impact, risk, and return. I'm going to actually just skip to this one. So this is a set of 18 loans that we closed in the last fiscal year, where we rated each loan we gave it an impact score, a profitability value, and a risk rating. And this is what we hope to do with our whole portfolio. I mean, we have like 170 loans on the book, so this is a super small sample. But this is really what we're driving to with the impact, risk, and profitability framework. If you see, we could see the scatter plot of all of our loans. They're graphed by profitability on the x-axis. So we're using that MIR number. Just think about positive as profitable. And we're y-axis has impact. The size of the dot is the relative risk. So a bigger dot means higher risk. And then the colors correspond to our racial equity tiers. So for example, here, we see this loan here, a housing project that is about a 7 on impact, 35% MIRR, so high on profit, kind of middling to low on impact, and okay on risk. We see this project over here that is higher on impact. It's low on profit, but it is higher on impact, and it's a little bit higher on risk. And we see this deal over here that's very high on impact, just over that 0 break-even point on profitability and middling on impact. We have to decide as an organization, is there room for all these loans in our portfolio? And which loans do we want to be doing more of? And how do we optimally balance so that we can, I mean, because I said we're nonprofit, but that doesn't mean no profit. We still have to earn some profitability on some loans. But what kind of loans should we be maybe getting not earning any profit on or taking more risk on, and figuring out how to optimally structure the portfolio is really what we're driving to. Like I would say this loan over here, it's a little bit lower on impact and it's negative profitability. Is there a world where we say we don't do this loan anymore because it's not serving our impact goals and it's not contributing to profitability? Those are all the questions we will be asking ourselves. I'm going to show these examples. So just this is a summary of those three examples that were called out there. This is the housing project. So this is in the current scorecard, it's 22, but that will increase to 25. So the impact score is 7 out of 22. It's racial equity centered. So this is a project that it will be building additional affordable housing units in a Black and Latino community. It's a place where low-income residents are at threat of displacement. So it's a historically disinvested neighborhood, but where there's a lot of new market rate housing going up. And so by creating this affordable housing, we're creating opportunity for people to stay in their community. And it's also considered a high opportunity area. So this is an area where there's access to quality schools, quality healthcare, and other things that one needs to thrive. And also the building itself is going to have a green community certification. So this is a certification that denotes a certain compliance with green standards. And we also think about that the sponsor, so sponsor means the developer that's building the building, has a track record of success. So these are this is like a summary of what shows up in the impact scorecard, the highlights of impact that give it that 7-point score. On the risk side, you see it's a pass high. So a 2, remember the risk scale is 1 to 5, lower number is better. So a 2 is pretty good. The organization that is the borrower has a strong management and financial track record. So that's a strength we look for when we think about likelihood of repayment. The repayment likelihood just on the fundamentals of the project itself, what the source of repayment is going to be. And then this is a lender term, LTV. Essentially, this means that we're taking security, taking a mortgage on the property itself. And so if something went wrong and we had to sell that property, we could likely sell it and get fully repaid. So it's a strong collateral coverage. And on profitability, it's high profit. What's driving that is really the loan size and also the interest rate. So that's just, this is how it breaks down. I'm going to do one more example real quick and then turn it to Jessica. Let's look at this one. So this one is an education project, a higher impact score than the previous one we saw. So it's an 11 out of 22. In education, so first, when we're evaluating schools, we have a tool we've developed internally called the Education Impact Tool, which helps to assess whether a school is creating an equitable environment for staff and students of color. And so we do think it ranks well in that Education Impact Tool. It is an innovative approach to programming. It has an Afrocentric curriculum, which is something new that not a lot of schools try, and it's a way to advance racial equity for the students. It's founded by majority Black leadership, has a very strong racial equity mission. And on the additionality point, so this is the LIIF special contribution, we're using some of our special capital tools, which are unique, not just our regular loan fund, but some other structuring pieces that allows us to stretch on risk. It's a bit lower on risk. So this is a 4. It's a startup school. They don't have a track record. There's no, they're just brand new. And so it's harder from a risk perspective for us to feel, as solid about repayment as on other loans. And it's also an unsecured loan. And the profitability is less than 0. So that has driven by the loan term and the loan size. But back here, we're willing to take on this risk and this concessionary profit because of the impact that's being driven. So this is all perspective, impact we expect, risk we expect, profit we expect. What happens when we actually make the loan? What happens on the project site? How do we figure that out? How do we learn from that? Jessica, take it away.
Great. Thank you, Eliisa. Jessica Standiford. I am a colleague of Eliisa's and the VP of Development and Impact Investing. And I've spent most of my career at LIIF really trying to articulate to our funders and investors the impact of our work. So it's very exciting that we are now at a point where we're making a strategic investment in bringing a new function at LIIF around learning and evaluation. And really that the idea around this new platform is to take the work that Eliisa's been leading with the IRP and most specifically our new impact framework and really gain a deeper understanding of what's happening in the communities and in the projects that we're supporting. So this is a new area for us, and that's why I was very excited to join this call, because I feel like I'm talking to the right audience and experts. So you will all know way more than me, and I invite your input during this call or at a later date. Very valuable at this point. So I think there was a bit of context given around the CDFI sector that we've historically been grounded in outputs, what kind of outputs we're generating. And really that was the whole, kind of approach was, gee, for community development, social science says that affordable housing is one of the most strongest interventions for upward mobility and lifting, disadvantaged people out of the places where they are and creating more opportunity. And, okay, so we're going to do affordable housing. Or, there's probably 4 or 5 interventions that LIIF specifically supports with our capital that kind of drive us towards, okay, how many outputs are we generating? Who's getting served? All that kind of stuff. And that's kind of historically where we've been. With our commitment to racial equity and our new impact framework that really is saying like, if we're about racial equity, we believe, and our theory of change is that we need to be driving power and agency for people of color. And what does that mean? How does that show up in our projects? And Eliisa really kind of walked you through what the things that we're looking for. And I would say this is all based on evidence and conversations and really kind of deep thinking, but accountability, we're about accountability, and we have a principle with that we have subscribed to that says we're going to be accountable to saying for driving racial equity, figuring out like what is actually happening. So we want to kind of go deeper on that aspect. So what are we going to do? I think, anytime you're trying to understand what's happening, evaluation comes, that the word just appears. So what does that mean for us? I think, we acknowledge that evaluation is going to play a role in helping us understand these deeper outcomes for people of color. I think where we are right now is really thinking about, where do we bring in third-party expertise to help us shape like evaluation approaches? Where do we bring in, experts within our own staffing to kind of help us build out? I think there's kind of this whole structural thing that I'm working on over the next 6 months. So I'll probably, we are doing kind of a more formal listening tour with experts and maybe one of you on the call to help us think about how to stand this new function up. And then, but we're also at the same time doing 2 pilots to help us learn, right? So we have 2 evaluation pilots that will be starting this year, and specifically to look at some work that we're doing within affordable housing on a new product that Eliisa is also leading, that's focused on providing a specific type of loan to Black developers that are focused on affordable housing, and then another pilot around early care and education and some of our interventions there. We all these 2 pilots really will help us inform kind of our broader approach to how we are going to create a more strategic impact management platform that goes alongside the IRP. So that's kind of where we are, I would say there's a few challenges and a few things that we're thinking about that I just also want to put out there. One is, you know, as a CDFI, we have historically had evaluation kind of, I wouldn't say done on us. Like a funder will come in and say, great, we're going to give you this funding to do something new and different within the sector, and we'll pay for evaluation. An evaluator comes in and, you know, might ask us a lot of questions and talk to the folks that we're serving, and then they're going to, you know, kind of put together, here's synthesized learnings, et cetera, et cetera. And that's been helpful. I would say that this is really, you know, where we want to get to is kind of driving that work, but also centering the voices of the communities that we're serving. So how do we put together kind of an outcomes framework and learning questions and a kind of a learning agenda that's driving our evaluation that is really defined and informed by the people that we're serving with our products or in the community. So how do they define success, right? So bringing that perspective in is really important to us as we, you know, kind of think about what does this framework look like? Are we going to study one loan a year? Are we going to just kind of study special initiatives? You know, how are we going to kind of understand what, you know, and test this idea around supporting projects that drive power and agency as being kind of a North Star for driving racial equity. So those are like big picture thoughts and ideas, and you know, invite any input and also questions on that. I guess there's a couple other things to point out that are also interesting challenges. I think LIIF is an intermediary, right? We're a financial intermediary. We can't get on the phone or go out into the community and walk to the projects that we're serving, like, you know, kind of a direct service type of nonprofit. So we need to be thinking about what does it mean to evaluate? What are we looking at? And what is actually like practical for in the role that we're playing? You know, so I think those are some themes and that we're kind of grappling with right now. So I will stop there. I think I wanted to, yes. Yeah, let's
open it up for questions. And I think I will stop sharing the screen unless anyone wants to see another slide, but questions.
Yeah, please go ahead or put your questions in the chat, or you can raise your hand. Oh, is this Courtney or Jane who raised her hand? Sorry.
I raised, oh,
Jane.
Oh,
yeah.
It's Jane under Courtney's link. Thank you.
Go ahead.
Thanks, Sasha. Wow, thanks for that fabulous presentation. I am so excited, and I can think of 1,000 audiences I want you to present that same presentation to. So, not that I'll really ask you for 1,000, but at least 10. So, but I really am very curious. I just wrote down a statement that said that this is informing your broader approach to impact management that goes along your IRP. And I think that's intriguing because impact management is being used as shorthand for impact measurement and management or evaluation. And what does that really mean when you're saying that this goes along, that this is your approach to impact management? What other inputs are there in that approach? How do you tightly align those? What are some of the issues that are going on internally as you're thinking about that? So that's my question. It's centered around those kinds of things.
That's a great question. I would say that because this is so nascent, so LIIF is predominantly a lending institution. And I think, and we have this new tool that's helping us drive what we think is, kind of the highest impact, drive our capital towards that, or at least help us understand how much of our capital is going into this kind of racial equity standout bucket. Beyond that, we do programmatic things. We do a lot of different things that are beyond lending or go alongside lending. And so, and those are typically funded by philanthropy, because they're like, great, we know that your lending needs to be sustainable, but we know that you can't kind of get to some of these like testing of new approaches unless you have us by your side to help you pay for them, because we have to keep the lights on. So I would say when we're thinking about impact measurement and management, we're thinking about kind of the broader platform at LIIF of what we want to do. I would say 80% or 90% is really going to come alongside our lending, right? Because that's kind of like the core of what we're doing, and the balance around some of the kind of innovative new approaches that might need to be further vetted out before we go out and talk to an investor and say, hey, do you want to invest in this in a more formal way? Typically we go to philanthropy. Hopefully that gives you an idea of like why I use that language, but also impact measurement and management. I mean, it's all together for us.
And I'll add from the lender perspective, and I should have said before, I was a lender at LIIF for 5 years before taking on this work, and I always think about things from a loan officer perspective. To me, impact management, forget that it's sort of capital I, capital M, but just generally how you operate as a lender. When impact has to be front and center, and how you think about where you should be spending your time, how you should be achieving your lending goals, that is a different approach to how you do your work. And it's in that kind of driving that business development with impact goals at the front, and also doing capital raising with impact at the center. To me, that's impact management, because it's so much of it ultimately comes down to behavior and how we what we look for, how we interact as lenders out in the field.
Thank you so much.
Yeah, I was going to say exactly what you're saying, Lisa, and I really like your classification across the racial equity tiers, because there is so much more than just increasing access that you can do for racial equity, and kind of once you have the tiers, there's more of a North Star that you're going towards, exactly as you're saying, in your behavior and your lending processes. I was actually wondering if these tiers were developed with the Global Impact Investing Network's new racial equity metrics that are part of the IRIS Plus system, and how you guys use that system.
So we developed these tiers before that system came out. We worked with Bridgespan Consulting, came in and worked with a bunch of internal folks at LIIF to think about, what is our philosophy around racial impact? Where do we see our capital making the most difference in community development? We did it. The new racial equity classifications from the GIN are really great and align in a lot of ways. We knew that notion of risk and power, it's good. Like we should all be thinking about this the same way, right? And so have drawn on that. I think what's back to kind of the lender perspective, it's really important to us for our lending team, and also LIIF-wide, for them to understand why these different dimensions are important and how they link to racial equity outcomes. And I think a lot of what the GIN has put together is great in sort of connecting those dots. Like, why is it important to center community voice in decision-making around a community development project? Because historically, Black and Brown people have been left out of agency, have not had a voice in these decisions. So sort of connecting the dots. So hope to leverage that even more as we train our team and get everybody up to speed.
Great, thanks. There's someone else who has a hand, Zazie.
Yes. Hi, everyone. It's the first time I joined this group, and I'm an evaluator, and I've come from government and philanthropic space and have moved into impact investing over the last couple of years, working as part of a developmental evaluation team with an impact investing fund based in the US. And one of the surprises for me when I come into this space, and I'm curious about whether this is something that does come up in your impact conversations or not, is impact at a portfolio level is often seen as just the amalgamation or addition of all the investments, but rarely do I see thinking around what's the systemic impact that we're creating lending the way we do. So what's our impact, for example, on investors, but also, and especially around the portfolio strategies and therefore the impact of the whole portfolio. Are we doing strategies that are trying to encourage systemic impacts that we might be able to report on that might be happening, for example, in a sector, on a particular issue, etc. I'm hoping that's making sense, but just curiosity on my part. Thank you very much.
Thanks for the question. And we didn't have time today to get deeper on the risk element of the impact risk profitability framework, because particularly when it comes to racial equity in the United States, risk, perceived risk, actual risk, who gets access to capital, who is deemed creditworthy, structural racism all over it. And that's something that we should be addressing and thinking about. At LIIF, we have some capital that allows us this sort of, I would consider, risk absorbing capital that we can put to high impact projects that allows us to say we're going to take on a little bit more risk and with this loan, because we have some risk absorbing capital we've received from philanthropy or from a bank that's allowing us to do that. Well, really philanthropy that really steps up there. That's great in that we're kind of shifting the risk back, but it doesn't necessarily get to the question of, well, why do we think this is risky in the first place? And that's really where kind of more of the learning and evaluation piece comes in, that we would like to get a better understanding of, is this loan actually more risky? And compare it to how does the loan perform? How does that repayment perform? What are the practices we're using when we underwrite the loan up front that may or may not be screening out different opportunities? And a lot of those kind of credit boxes are rooted in a system that is part of our history of structural racism. So yes, and we're exploring it, figuring it out. Don't know the answer yet, but I think Jess's work will be really helpful with that.
Yeah, and I was just going to chime in to echo that. I think going beyond kind of portfolio-wide impact, as you were talking about, one of our big targets is the traditional investing community, right? And traditional capital and traditional banks. How do we kind of create more avenues where that capital comes in to invest in racial equity kind of focused work? A lot of folks have made big commitments, right? Out there around, 5 billion or 50 billion toward, over the next, several years. And a lot of corporate money has been earmarked or at least verbally committed. And I think the systems change work that we're trying to do to kind of both stand up, frameworks that we believe will have the most impact on people, one, and then two, looking at the way that we're, going about and kind of modifying our underwriting criteria to take on more risk with the help of philanthropy to support certain types of projects or loans. Like, what happened with those? Do they actually need all of that, extra attention? And are they actually that risky? I think those are the things that we're kind of trying to learn and evaluate to have that broader portfolio-wide impact on the traditional capital that's out there, that we would like to drive more capital to this type of work.
I see that we're in time, but if people can stay, I see Spencer has a question. We can keep the webinar open, but we understand if some people need to leave. Go ahead, Spencer. If Eliisa and Jessica and Mike are okay. Yeah.
Oh, thanks. Sorry, I think I thought it was going to 9:30, but yeah, thanks so much for the time. And I'm at Kiva. I'm an impact director there, and our framework is very, very similar. We have a risk score 1 to 5. We have an impact score. We have a lot very similar scores, and we have the same kind of 2x2 graph. And where I find myself today is that we're doing pretty good on our estimated predicted impact score. It's always pretty good. I think the organization's gotten used to that framework. I don't want to say we've gotten lazy, but it's not really, it's still just a predicted score. So we're starting to have these questions. How do we communicate to the org at a portfolio level on real outcomes? How does that inform our predicted score? How much should we invest as an organization in outcome measurement to then validate our prediction? And we don't really communicate those outcomes. And so is your North Star really like at the end of the year, you say we did a good job, we hit our impact score prediction benchmark? Or is it we followed up with this low-income housing development and we interviewed the residents there and they thought that they were paying lower rates than they used to? Like, how do you balance that North Star goal from an impact perspective between outcomes and prediction?
Great question, Spencer. And that's what we're trying to figure out in terms of where do we want to, we have decided to make an investment. And so the money is there, and so to speak, in terms of like, we're going to fund this at LIIF. In my conversations with Mike, who did this at Root Capital, like they chose to do an impact study on, and Mike can speak up, but on, 1 or 2 loans or, a year, and that were emblematic maybe of some learning questions that they were trying to kind of understand to sharpen their work and their impact framework. That might be the direction we go. Or it might be, more thematic in terms of our approach, meaning, should we look at a specific intervention across a few projects? Or I'm not quite sure, but I do know that the pilots that we're doing right now in evaluation will help inform kind of what was most useful from that process. And they're pretty robust efforts. And also, what are we hearing from the field as like financial intermediaries? What's working for others? What's not? What's kind of doing a lot of listening. And I don't know if you're in the Bay Area. I am. We've also been talking with the San Francisco Foundation as well about some of the framework that they have set up for learning and evaluation, which has been important. Happy to introduce you to them. That was a really helpful conversation with their group.
That's great. Thank you. Yeah, I'm in Seattle, but a lot of my team is in SF, and I'm there often. So hope to connect. Thanks.
Great. Are there any other questions, comments? I don't see any, but yeah, Eliisa and Jessica, I would love to connect with you more, especially about the learning piece. I think that's a really complicated piece that people haven't necessarily figured out, and it kind of speaks to what you asked, Spencer, as well. So maybe we can connect offline. I think it's there's not like this is how you do it. There's let's talk about how best to do it. Yeah, if there's no more questions, I just want to say a huge thank you to Mike, Eliisa, and Jessica. This is such a great presentation, and thank you everyone for joining. Recording will be available, and we'll try to send the chat as well. I saw that Mike put in a really good resource higher up. I can't